In the stock market, there are two emotions, fear and greed. At the moment, it could be that the markets are getting a little bit too greedy, but what's more surprising is the way that it's doing so. For such a small rally in the markets, we have volatility dropping hard, and today we explore the statistics over the last 50 years to figure out what this means for markets. Also, we'll be talking about, of course, breadth. Yes, unfortunately, it's even worse than we thought. For over 16 years, we've never seen a lower reading when it comes to how the market is rallying at this stage. Should we be concerned? We'll go over the stats later on. Let's get involved in the stocks, commodities, and crypto markets right now together. See you soon. Well, welcome back everyone to the Daily Show where we talk about markets around the world. We've got the latest news, the latest macro, and of course the lead indicators and the hottest charts coming your way in the show. It's going to be a great one. If it's your first time here, welcome to the community. Consider subscribing and smash that like button if you find value in today's video. Let's talk about the pain trade to start off with. So what is the pain trade? Well, generally, it's the way where the market goes in a direction that most people don't expect. In 2023, I guess it's been to the upside, led by big tech and high gamma stocks. And of course, most people are looking at a recession, negativity, all this type of thing. And we could still be at the precipice of that. And we'll talk about that later on today in the video as sentiment is starting to shift. Now, I noticed on this article, they've started bringing up our survey reports, which we've been using for over 2 years now. And yes, neutrality is the current one. Maybe they watch the show, who knows? But 39.5% of people are neutral. And that means that people are confused. Now, when we see confusion or we see a huge bullish move from retail herd traders and we're at a key resistance, that's when we should be most cautious in the markets. We don't generally want to go with the retail herd. We want to go with the money flow. And we saw the money flow come in mid-March. We saw it rally up and it started to drop off during this coiling period of the market. And we'll look at that later on as we assess the markets overall. So earnings season is upon us and Netflix came out with a result and instantaneously the stock dropped heavily. But just like everything else recently, we saw huge buying really counter that. And by the end of the session, after hours, we were basically flat, slightly up. It went down to I think almost $300 at one point. All eyes will move on to Tesla and the market is realistically holding as best it can. But I've got maybe an example of why that could be, and it has to do with the VIX in just a few seconds. Fear and greed index, that's at 68. We've seen this reading drop 2 points over the last 24 hours. But I wanted to bring to our attention this one here, which is the gamma distribution of the VIX. Now, it's set to expire, I believe, over the next 24 hours. So basically, we're going to see the VIX pin of 17 evaporate. And this could mean, well, it probably will mean increased volatility. So we know that's coming in, but that makes sense because it's the third week options expiration. Now, as we know, there's over 3 million S&P 500 futures market, S&P, SPY kind of options market, options expiring. Plus, we've also got some of the biggest options expirations of the month. So this is coupled with increased volatility expected, and some people are talking about this might mean that SPX futures are actually sold back into the market, pushing down price. And that certainly is something we're looking at now over the next 24 hours. If we go over here onto our Twitter as well, I've posted something that I think is pretty interesting, and that is, again, around the lines of breadth. Now, we're seeing S&P 500 breadth the least since 2005. Now, I've gone over some of these periods that we've seen previously low breadth, and it hasn't meant that the market is looking cataclysmic or anything like that, but it can sign actually the beginning of a new bull run. Usually there's a pullback after such a thing, and then we get, the further rallies with the complete market. Now, I've likened this to a pizza, and if the more slices that the pizza shop is selling, the stronger the trend. But the fewer slices they're selling, the trend might not be as strong. So really, the trend doesn't look as strong as some people would suspect when it comes to this recent rally. Now, over in the global financial crisis, 2009, if you look at January and you look past that point, you'll actually notice that we see a rally, then we see an instantaneous dump, and that actually was where the bottom was in the market. So will we have a similar time to that? Of course, you can just say, well, it's different this time. Yeah, it could be. It's something that I think is quite interesting. Let's talk about VIX. So the volatility index is dropping hard yet the market isn't even making new highs. It's a rally that is relatively small in comparison to the VIX drop-off. And historically, we can now pull some synergies from that and previous times. Now, notice here, when we get these types of reports, often we actually are in a recovery phase in the markets. So that might be good if you're a bull on the markets. However, look at the 2-week and 1-month stats. Now, I've said this before, 68% of the time, pretty much markets are bullish. So if you're seeing stats that are underneath that, that could mean a decent bearish kind of capitulation style of market. Now, 2 weeks to 1 month later, we're seeing returns that are quite negative for markets after getting this. So this is when the S&P 500 rises less than 5% over 90 days, while historic volatility drops by over 50%. So is it really a super bull run? It's more of a rotation into certain stocks. It's actually not a complete bull run. We can see that in the breadth as well. Which sectors tend to do poorly? Well, you can see 2 weeks later after these results what happens. Energy is usually the standout bad return, maybe demand destruction also could be there in play here. And you can see across the board, most sectors are down. But just like anything with the market, overall over the next year, theoretically, it is up when you see these types of reads. Now, is the S&P 500 volatility low? Well, historically, not really. I mean, actually between 10.3 and 15.8, which we could be getting into soon, we hit there about 34% of the time. I like to think of the VIX as anything under 20 is pretty much like more of a bullish style market, or at least fear is gone. And anything over 30 is usually where you want to start looking at that buy the dip, what kind of things are occurring. 40 plus, certainly, that could be some capitulation. And over the years, I've used the VIX quite effectively, especially with the 40 plus kind of read, to find some of the beautiful lows along with technicals in the markets. So what else is occurring right now? Well, this is something that we haven't seen for a long time, the move into bonds. Yes, I've been talking about bonds for a while, and I think at the back end, especially of 2022, bonds were some of the most attractive asset classes on the markets. They're still pretty good, and specifically things like corps and some treasuries or government bonds are still fairly attractive in comparison to stocks. And we talk about this from ERP, which we'll bring up later on today's video. Now, we can look at the similarities here with other periods of time. This was a small switch to bonds, and then, of course, it went straight into equities. We need to be careful here because historically, bonds have not held for a very long period of time, and this will have to do with more the Fed pivot, and interest rates. So interesting to see that there. Now, is the sentiment still bearish across the world? Yes, we can still see the huge pessimism. Generally, it is easier to sell a market which has actually got optimism in it, because if you're seeing everyone else is optimistic and you're seeing problems in the market, more likely you're going to get a huge move. When there's so much pessimism, it's tough for the market to capitulate and fall off very hard. Those watershed moments tend not to happen as much. Into earnings season, I brought this up in the last video, so I won't talk about too much, but it's the 14th, the best since 1950 in terms of run-up, 6% in terms of the overall run. And when we're seeing runs like this prior to earnings season, again, it loads with those other stats that say maybe we need to be cautious over this next 2 week to 1 to 2 month period. Have a look at Q1 only results. Oh, it's not good there for the next 1 week all the way to 3 months. We don't have too much data from it, but I tell you what, that is damning evidence when you're looking at these markets where they are, the fact that the breadth is so bad and the S&P 500 is returning very well coming into earnings. It's what they call the buy the rumor, sell the fact kind of event. So we know that markets are neutral. 39.5% of people were feeling very neutral last week. I'm super interested to see this week's report and whether they've gone bullish. We also know that equity risk premium is why so many of these big managers are in bonds. They're basically saying, unless I can get like 9% out of equities, I'm probably better off in bonds, because they're all about capital preservation and making sure that they don't miss out on rallies, but they also don't lose too much. I mean, the capital preservation is a big deal. This has now moved underneath or around that 1.7 reading. And when we get this, it's less scary to miss out on market rallies, because history would tell you, yes, we hit this 35% of the time, but the market returns when ERP is in this range is usually not very good. It's only 5.9%. Now, that's not much better than cash rate when you think about it. So FOMO should not be something that investors necessarily feel as much. It could be wrong, but it shouldn't be necessarily felt as much. Think about forward PE, think about all of those types of things. I just want to bring that into the channel here when we're talking together about all this stuff, that maybe we don't need to feel as much FOMO, even though you might have seen exceptional returns in AI stocks, etc. When it's above 1.7, hey, yeah, I mean, the stats say for themselves, exceptional returns over those periods. And I think this is something that is underutilized by many traders out there. We also know ERP should spike hard, and it should spike hard during a recession. The Feds told us a recession is coming. They said it's mild. So if a recession's coming, we should see ERP spike. It's always happened in the past. Why wouldn't it happen in the future? So did Netflix live up to its name of 9% moves? Yes, the implied vol technically was there. I mean, we saw Netflix after the close, and it did actually move around 8 to 9%. However, then it instantly rebounded up. So with that expectation in mind, Tesla, all eyes are on. This will be the first big tech that I believe most people are going to be looking at in the markets. 8% expected move. We'll look at what that means for the stock a little bit later on. But yeah, Tesla's going to be all eyes on that. What happened in the rotation during the last 5 days? We like to look at rotation. Utilities has come out of focus. Yep, I'm done with utilities now. It did what we achieved, and it was very nice. Did it beat tech overall? I thought it would, and I did call it here on the channel that it would beat tech over the last month. It missed it by a couple of percent, but still did damn well. So utilities was a great rotation, and what it was really a symbol of was seeing things a little bit differently. No one cared about utilities, yet it actually didn't scare anyone, really. It was a pretty solid trade, and it just kind of floated through that whole Silicon Valley Bank and the whole Credit Suisse crisis fairly well in comparison to what tech was doing, which was jumping up and down all around. Now we've moved into financials as the reports coming in that are a little bit better, but here's where things get a little bit different. Look at KRE over the last 24 hours. This is regional banks. No, the regional banks have started reporting, and some are good and some are bad. It's a mixed result, down 2.16%. That's going to be a sector that we'll watch. We'll look at the charts later on in today's video, but this is certainly one that we're watching. Gold was up through the session. Everything else was kind of mixed. So not too much information there. So just before we jump into the charts and look at all of the hottest levels that you need to be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, I'm sure you're all aware that we're in earnings season. Q1 earnings is here and coming, and Q2 will be one of the most important points to watch this year. So having a great economic calendar is going to be very important. Not only does Tiger Brokers provide you up-to-date news and release reports instantaneously throughout the chart, refreshing every 1 minute, but you can also select the country and the type of announcement that you're interested in with daily, weekly, and monthly formats. Now, as we've mentioned in this video, and we're about to talk about more, Tesla is just coming up, and this is going to be a huge report announcement. One of the things I like about the Tiger Brokers platform is that you can watch certain earnings calls within the platform without having to go somewhere else to find the link and get involved in that market. Also, being able to see market overviews with customization like Tiger Brokers has, and sector rotations with many different concepts is a very powerful concept that we talk about all the time on this channel. So if you're interested in getting involved with Tiger Brokers and checking out some of their options and of course their platform overall, then you can do so with the links in the description down below. There's a whole bunch of special offers, and of course one of my favorite stocks has returned as an extra special for the FX Evolution community. If you're a member from the Australian market, you'll get a further US $25 worth of Microsoft fractional stocks, and that brings you up to a total of US $80 of fractional shares plus a bunch of other special offers. All you have to do is fund with as little as 1 cent. So what are you waiting for? Check them out today. All right, well, let's get into the charts. Let's begin here with our big story on breadth. We saw before that in 16 years, we've never seen breadth so bad when it comes to a rally. Here's the Russell 3000. That is 98% of the market, and we still have very bad breadth. Basically, last rally, we got about 70% of all the stocks coming up. Now we're sitting in the 40s. So 40 pluses, that's not really where you want to be, and it's not boding well. I mean, I think we're sitting at the today about 45, 46 with this rally. So not really a very strong rally indeed. The VIX is coming down to our level. It almost actually spiked down to the January 22 lows. I'm very cautious of the market around here. This is exactly where basically fear jumps out of the market and greed takes over. You can see it represented by the VIX. And you might say, well, the VIX is broken, Tom. 0 DTEs killed it. Man, maybe. But overall, this is where I am starting to get fearful because of this rally and also the way that the market is interfering with this zone. Like we saw a big rally in the pre-market, it sold off. It actually offered a pretty good opportunity for people that know how to trade that type of market. We'll talk about that later, but that was the big story. Yields are also rising. That's historically not been great for markets. Markets have historically dropped after this, though it is a lag. And this is because they're mean reverting after that initial shock from Silicon Valley Bank and Credit Suisse, which said, hey, Fed, we need your support. If I was to simplify a chart for you, this is basically what the Fed is doing right now on a chart. That's what they're telling us is going to happen. This is what the bonds market believes is going to happen over the next 12 months. So the bonds market's claiming there's going to be cuts. The Fed is literally telling you, no, we're not going to cut. This could be one of those inflection points where the market fights with the Fed and then all of a sudden we're a little bit lower. And of course, we will be watching Fed liquidity very closely on this chart. And that's something that we're very much focused on. If I see liquidity spiking again, I see the Fed injecting secretly, I will be the first to bring it up here on the channel. And hopefully that will help many investors out there because this market is pretty much 70% the Fed nowadays. And they're not going to stop, of course, supporting the market overall. However, at the moment, they're playing yo-yo to try to deal with the inflation problem. What about PCC, put call ratio? Well, the daily was down back to 0.923. We like to see it down there if you're expecting, of course, volatility shocks and markets to go back up. So the level of puts less and less per day, which is positive if you're actually a bear in the markets because you don't really want to see a huge amount of puts. Usually the market would go up over that period. What about high yield bonds? They were down on the session. The session was flat. So again, no real inkling here from high yield bonds, but we are watching those. Treasuries hit kind of a support. So I'd like to see treasuries find some buyers. You can see here it gapped below. It's now created what could be an island reversal if it gaps above. So this one here will be very interesting. And speaking of island reversals, if we have a look at things like Goldman Sachs, this is an interesting one because you can see here it gapped below, had a rally, which I expected, but look at that, gap up, gap down. So it's actually primed based with the trend line to see weakness. And this is a very interesting point for stocks like this. So I think that's something I just wanted to bring up to our attention. If you want me to bring more individual stocks in than I'm seeing at the times, let me know in the comments down below. We could always have like a stock of the week or some charts of the day and stuff like that in the show. And we can put a slider in there that might help out with being able to see more markets because we cover so many markets here on the channel, but of course, we don't always go into any specific stock. We usually cover the main big ones. Let's move over here to the dollar index. Now, dollar index is at demand, I guess you would claim. I'm not super won over with the structure creation. So obviously I thought that we'd sell there. So far, so good. Huge amount of trade going through that zone. There is a little bit of trade here in the recent kind of block. So yeah, there's a decent amount of buyers that have come in here. But if this gets taken, I would say that could be, head and shoulders, dollar continues to fail. Not really won over either way. Some kind of chess plays that you might be looking at, maybe comes back, retests, takes out all the stop losses that are here, then rallies through and we then breach through 101.64. At that point, I'd be looking for it back into this trend line. So basically something like this. And that would be the play that I'd go with. But I'm not really won over by dollar either way at this stage. Look at the weekly. Obviously, the weekly closed lower. That pretty much points to me that rallies will be met by sell demand. And, overall with the dollar, it's more of a scalp, more of a swing short at this stage. Let's move over to copper here quickly. Copper continues to test from the top down onto this trend line. I'm looking for copper to breach through 405.23. I've been negative on copper since literally January. So at this stage, I still remain negative due to the weekly close. However, it's touch and go, and this week will be another important one. We'll continue to watch copper. They call it Dr. Copper because it shows us the health of the economy around the world. Let's move over to gold. Most traded zone, anything between 1976 and 1980. Lots of people are liking to buy in that area. So that's why we've bounced. I would like to see with gold that it breaches past 2015 if you're a bull, and if you're a bear, you just want it underneath this price. If that happens, then rallies should be met by sell demand. And I could see an excellent trade either way coming up on gold, though I don't like the current zone. I don't find much value in that. Natural gas has continued its strength up. We spoke about this. I've been very bullish in this area down here, and rightfully so, I guess. It's doing well. So congrats to natural gas players. I mean, it's up 17.67%. It could do that in a day. This stock is wild, or at least this futures is wild. You can see kind of the way it's gapped up. I wouldn't be surprised at all for it to fill that, but I think buyers at this stage are committing to natural gas. It's a dangerous trade, but it's got some of the signs that you want to see with a base formation. Let's move over to US oil. So this was the scalpy zone. We've actually seen a pretty nice turnaround. It took out this high here. So we now have a higher high, and we're kind of pulling back a little bit on that. I'd like to see something around this scalp zone again get picked up, and basically something like this, and then we move into 81, 80, 82 plus. And then at that point, we have to see whether the sellers recommence. So I've got a box up here. I'm liking the bullish side more than the bearish side at this stage, I guess, on oil in terms of the really small timeframes. And yeah, we can see here long leg doji. So if you're a really big bear though on oil, you really need 79,331 to be taken. Once that level is closed below, you're looking at rallies being met by sell demand. This will be a big shift, and I'm interested in seeing how oil ends up playing out. What about Tesla leading into earnings? Well, we've kind of got it trapped. We've got expected options lows. We know this has been a buy zone. So if news goes like this, then that could be the old classic stop loss hunt. We have up here where profit target players may kind of sit. And I could see the market kind of gapping into this or this zone after the earnings, and then maybe there's a reaction off those areas. We know heavily traded zone between 195 and 200. Calls sit all over this week. And if we go to the option strikes, you can see here we've got 200, 190s, and 150s. So anything in between that kind of 190, 150 is A-OK by the options market. And you'll notice that people are starting to stack puts. And the max pain is literally where it is right now, 185. So I think it's more of a catalyst for other stocks, Tesla, to see whether there really is this negativity in the market or whether there's a bit more positivity coming through. So 306, I think, is where we got to in the futures, and you can see why. 305, trend line coming through for Netflix, kind of went like this and this. I'm surprised it held the bull. So I wouldn't be surprised at all to see it come back down and maybe retest into this area. But that's why bulls bought there. There was the trend line coming through, and Netflix itself, it's in a little bit of a consolidation at this point. So nothing much going on there. Let's have a look at Apple. So Apple continues to play with our trend line. The trend line of 2022 continues to hold. We've now got a spike above. So everyone that had stop losses here, they've been lost. And are we moving to a double top? I am watching that chart a lot. Apple will be watched over the next week, especially to tell us whether we're in a more sustained sell-off if we get one, or whether we're in, further bullish pressure. XLC, this is communications. You can see that it's at that resistance high along with many market leaders. All these market leaders, semiconductors, XLC, XLK, big tech, all of the things that have all this breadth behind them, they're the ones that are strengthening this market. They're all at resistance. So we have to be concerned, because if the earnings don't stack up, all of a sudden, bang, then you go back down. Look at KRE. It's still struggling. So we saw that big rally into a drop. I'm watching KRE around 41.38. I want to know how it reacts to that. Keep bringing it back on. These are regional bank ETFs. So that's obviously the weakness that could be going on this earnings season. Here's the DAX, the German market. You can see the highs over here at that 15 kind of 9. So 15.916 is where I expect some targeting profits. If you're looking at this on a chart though, you can't really think there's a bear here yet. We didn't see the sell-off we were looking for here. So it's just grinding higher at this stage. So there's nothing much weakness about the DAX. It's just at that zone. It's similar story for the XJO. The Australian market is making these new little highs. It's darting around with these points, and it's probably waiting for the US lead. So yeah, we haven't got the lead yet. The Australian market is bounding up here. We thought this was an interesting zone. It ended up finding the buyers. I didn't think we'd get above here so quickly, but we have. So yeah, we're just kind of trapped there waiting for the US market. Now let's talk about the big ones. Russell 2000. Look at the Russell 2000. It rejected the 1810 again, and it has continued to make a series of higher lows throughout this process. So here is a very important point for the Russell 2000. If the markets do start to rally, you've got to think that, okay, well, if we're getting a rally past the new highs, we know that the big stocks have already led the charge. So maybe it's time for the small chart stocks to start leading after that. And that's usually what happens. Big ones lead, then we get a pullback. Then if it's a real rally, the small ones come with it. And that's probably where the better returns will be. You've got to think outside that box. But we haven't seen the small ones come through yet. Here's another long leg doji into earnings. So again, still holding that high, unable to get through. Let's have a look at IWM, the ETF. And again, you'll see just unable to get any closures above this point. Looks different as a chart, but overall just the exact same concepts. Let's move over to the Qs. The Qs came into our red box over the last 24 hours. You can see here, watch reaction level. My goodness, I mean, it's almost nailed that level and then shorted straight off. So again, could be posting a double top. It's possible. And here's the gap fill that it's looking for. So where are buyers? Most likely they're convincing around here. And of course, a double top, actually the length of the double top, if that was occurring, would be this A equals B kind of thing. So that would move to the other gap fill and the low. So at this stage, we kind of play with this high and we just find these small rejections. Here's the NASDAQ in futures form. You can see there the shooting star style rejection, or pin bar as some people call it, again coming into our levels and tapping them. Symptomatic of usually where bears would sit. And in our private community, I talked about this, and the bears certainly did sit there on the US 500. Let's have a look at the US 500. So it came into our expected weekly options high level, extreme zone 1 that I've got marked of the two extreme zones. The second one's actually up here. I don't know why it's gone away, but the SPX will show you it. So there you go. So extreme zone 1 was hit. Trend line still relatively intact, I feel. Maybe you could say it's through it a little bit. We've got 4 gaps on the way down. So that basically means that the market, it has, if it really should come and fill some of the gaps that's left behind. But the short in the previous day was spectacular. And that's because it was going for a gap fill of the day. But more importantly, the way it's set up in here was very symptomatic of something I teach in the Advanced Scalping Masterclass. Links in the description down below. Ended up being a 5-to-1 trade. It was a really excellent short through here. And it was certainly in that extreme level. So, if you were talking about, wins and losses, obviously there's a loss in here from the short, very similar type of setup. And then over here, there's a nice win. It happened in crypto as well, and it happened in a few other markets. So we've now seen the market go to this little bit of a lower low. Again, it's time for bears to get control of this market. They have to do it in here. And if they can't do it, it's going to be a big problem. That's where the bulls, fully get control. So it keeps grinding higher. I mean, you can see here, it's like grinding with dojis and wicks, and it's just, you can't hate on it. If you're a bull, you can't be afraid until it gets realistically underneath something like 40.68. So you have to just keep thinking, well, this is bullish, this is bullish. Yes, I know the trend's up, but it's just now or never. This is just such a big level. And I know I keep ranting on about it, but it's because it really is. I'm looking at this like where the bears should take control. I'm looking for the signs. If I see a sign bullish though, and the markets, do a nice switch for a scalp-based bull, I'd take it too. I'd take either side. I'd take anything if you get the right opportunity. I think that's why it's always important to have patience, reacting and not predicting. I might have a negative tinge bias on the markets right now, but that means I'm still open to the markets going to 4,300, 4,350 before they even go negative. It's possible due to the pain trade, due to what I know is involved in markets. And they often push, there's that kind of common concept, which is the markets can stay irrational longer than you can remain solvent. So that's another big thing. And generally speaking, yes, markets will stop about 80% of the way to the highs, and then they'll consolidate like they have, and then they'll bust through. We still don't have the bust sign. We don't have a daily close above, so I'm not going to say we're through because we're not. And we haven't seen the daily through, and at this stage, there could be some still further weakness. Trend lines also could be touched. Markets coming down to fill these 4 unfilled gaps. And yeah, I mean, that could be a good zone. So I'd say we're still at a pretty interesting short level, and we're heading into volatility. The VIX pin, all sorts of things are coming through, plus the 3-week options expiration. Now, if we refresh this is where things get a little interesting. Maximum pain, which is the only week we really bother using it at the moment, is 403. Current pricing on the market is 413.90. So that actually opens up further downside momentum as we see these VIX options expire, or at least those positions expire, and we see that potentially hedges could be sold into the market. 3.414 million units outstanding, so a lot of money at stake here. And technically, the best profit for the street is to push it down into the 403s, 404s. Let's have a look at Bitcoin now, as often people consider that a lead. I'm not sure if I can consider it a lead, but certainly it's one of the ones that we like to look at. And of course, I'm very interested in Bitcoin at these prices. So in the previous video, we talked about this little block here, and we talked about how if the market got through this level, we expected it to go here. Well, it did. If you took that trade, congrats to you. Very, very nice. Certainly a extreme rally. Now it's trying to stop itself though. This is a heavily traded zone. We know that there's a lot of transactions that have gone through here, whether they're bullish or bearish. So it makes sense the bears would sit here. Possibly we've already seen a small turn here on the smaller timeframes towards the short, and we're retesting that 30,400 level. So I could see a couple of scenarios. Scenario one, we kind of take these highs, then instantly sell. If that then happens, then I'd be on the sell wagon. At this stage, I think I'd probably be more towards the sell side than the bull side. If we end up getting a closure above here, then you've just got to believe the bulls are going to pack a new high. And at that point, things are looking much better. The trend is still up. However, there has been some switches to the downside based on things like 2 hours and possibly even the 3-hour and 4-hour chart. Daily still remains quite bullish. So yeah, critical zone, bears here. It's the same old story. We're probably waiting for those earnings reports to come out. Let's move over now to the week ahead in terms of data. We know that it's not really a data-driven week. It's more of an earnings season. We have unemployment claims Thursday at 8:30 a.m. Then we have, of course, a whole bunch of data, including flash services PMI. And that's the data for the week. If you enjoyed today's video, please consider subscribing. Smash that like button. Thanks so much for being an awesome community. You can get a few free trading sheet seats as well if you click on the link and just put in your email address. And other than that, I guess I just wanted to say a big thank you to the community in general. It's been great over the last couple of months with your support. And if you're interested as well, a sponsor of today's video is, of course, Tiger Brokers. You can check out their special offers. And remember, I did manage to secure the Australian viewers out there some extra Microsoft fractional shares. For everybody else around the world, check out the links. There are still a bunch of special offers for you as well. Thanks so much. Bye for now.